Okay. I can read it open. You can answer it. Will PWL ever open a branch in the US? What would be the main challenges or obstacles? Do you associate with any US based advisors or plan to open branches in the US? I have a family member to whom I'd like to recommend your services.
So with the One Digital transaction, we are owned by a firm that has an RIA in the US. And we have connected with people over there who are very similar to PWL in terms of their approach to planning and investment philosophy. So we're happy to make introductions to those folks on the One Digital side. I guess just reach out by email. How do people contact us? Contact form on the website, probably. That
Yeah,
probably
mostly.
makes sense.
Yeah. Okay.
All right. Should I read the next one?
Sure.
What does the investing literature say about huge piles of cash being parked in T-bills from multi-billion-dollar companies? How does the strategy compare to the time in the market common wisdom? Is there a point where the risk reward is just too high due to the sheer amount of money generating millions a year in country-backed interest payments anyways? Kind of an interesting question. I think this people worry about this. People see big companies holding large amounts of cash and think that maybe they should be holding large amounts of cash too. I think it's important to remember that companies are not like households. They don't typically invest in a diversified portfolio of stocks with their excess cash. So I don't think we can really call them out for market timing in the same way. They could be holding out for investment opportunities that haven't come around yet. Like that's what Warren Buffett talks about, for example. It could be precautionary savings, like they're hedging against some kind of risk for the operations of the business. One of the other things that comes up in the literature on this is agency conflicts, where management doesn't want to distribute cash to shareholders. There's a 2012 paper in the Journal of Financial Economics that finds that riskier firms have higher savings, which does imply a positive relation between expected equity returns and cash holdings, which is kind of interesting. And the paper does find that to be true empirically, that higher cash holdings are associated with higher expected returns. Buffett, like I mentioned, does talk about Berkshire Hathaway's cash. He was asked about it at the 2019 shareholder meeting. And he kind of says that, like, yeah, investing in an S&P 500 index fund could be a reasonable strategy. And he hasn't done it, but whoever takes Berkshire over after him, he's like, they may want to consider it. He does note that being in index funds in 2007 or 2008 might have changed the way they were able to respond to that situation, because they did make some pretty opportunistic moves. Right now, Buffett looks quite smart because they've got a ton of cash. I think they sold out of Apple basically at the top, and they've got a huge pile of cash right now when the market's crashing. So we'll see what Buffett's next move is. I'm quite interested. After COVID, a lot of companies did start hoarding a lot more cash. There was a post from the Federal Reserve Bank of Kansas City that looked at this. Why are companies holding cash? And they found that investment opportunities, which they measured by the ratio of a firm's market value to its book value, explains the largest portion of the cash ratio, both before and after the pandemic. So that kind of suggests that investment opportunities are a big one. But, there are lots of interesting reasons why companies might hold a lot of cash. I don't think any of it matters to a retail investor making decisions for their household.
Agree.
They're really not parallel, are they? I mean, their risks are very different, and so I wouldn't read too much into it.
Yep. Agree.
Let me read the next one here.
All right.
What is the probability that over a period of 10 plus years, an addition of bonds to a portfolio will enhance the returns? To rephrase the question, other than serving as a behavioral anchor, do bonds add any actual real value to a portfolio nowadays? If you choose to elaborate even more, VGRO, for example, also includes international bonds to the mix. Does that change your answer in any meaningful way? Well, we obviously covered the big part of this already, but you've got some additional information here to add, Ben.
Well, you said it earlier, Dan. Bonds are not really there to enhance returns. That's just not why you invest in bonds. Scott Cederberg does have another paper looking specifically at long horizon asset returns for stocks, bonds, and bills. And they have data in the paper for the 10-year horizon specifically. So I looked at that to answer this question. They find that 30% of their simulated outcomes have negative real returns for bonds at the 10-year horizon, while it's only 18% for international stocks and 22% for domestic stocks. So they're all pretty risky at a 10-year horizon, but in real terms, as with their longer term data, bonds are a little bit riskier. An interesting thing is that even in the tails, so if you look at the first percentile outcomes, the worst outcomes at the 10-year horizon, bonds again look worse than stocks. Now it is possible that bonds zig while stocks zag, which gives you a diversification benefit. But the interesting thing, and I think one of the big things that they find in their research is that largely goes away, or at least is diminished at longer horizons. So at a monthly horizon, the correlation between stocks and bonds has a correlation coefficient of 0.18. But if you look at the 30-year horizon, that goes up to 0.46. So that's that, I guess. I do think it's important that in nominal terms, so not accounting for inflation, bonds offer stability, which matters for behavior, as we've been talking about. And then longer maturity real return bonds can offer a perfect inflation hedge, but can also be very volatile in the short term.
I think the other component being the question about international bonds is interesting, right? Because on the one hand, the fixed income component of your portfolio is intended to be there for kind of safety of capital, right? It's there to reduce volatility. And if you have international bonds, you have either one of two things. You have an additional currency risk, usually, or you've hedged that risk, which then usually comes with an additional cost. And I don't know the answer to this, maybe you know, but the cost to hedge back to your home currency, that cost likely eats up a good chunk, if not all of the delta between interest rates in that foreign currency and interest rates at home, right? So you probably end up kind of somewhere in the same place. And I'm not sure that you would add any sort of meaningful source of diversification if you add international hedged bonds to a portfolio. I don't know if either of you have thought further about this, but I'd be curious to hear what you have to say.
Do you have thoughts, Dan?
Yeah, I mean, I agree with you that if you introduce currency risk, then you've kind of defeated the purpose. Because if the goal of bonds in your portfolio is to reduce volatility, once you add currency exposure, you lose that, right? The portfolio is probably more volatile now. And then the second part is, like you said, well, you can hedge the currency, but if you hedge the currency, the additional diversification benefit is really minimal. The only thing I would say would be if you were investing in bonds that had any meaningful risk of default, then, if I lived in a country where I was genuinely concerned that the federal bonds would default, then I would want some international fixed income with currency hedging. In a country like Canada or the US, where that's a remote possibility, I think you can just safely invest in domestic bonds only, and then you don't have to add the currency hedging. And that's what we do. I mean, we don't use any kind of international bonds, except if you're holding a fund like VGRO or VBAL, it's built in. The iShares versions, interestingly, of those asset allocation ETFs include only US bonds and no international bonds. Personally, I don't think you need either one.
Yeah, in the case of Vanguard, they actually have a bit of a foreign withholding tax cost on their international bonds as well, which makes it a little bit tougher even to justify. Dimensional does use international bonds, but it's for a different reason. Like they're doing a variable maturity and a variable credit strategy, and being global gives them more opportunities to look for places where those things may exist, where there's a wider credit spread or where there's a steeper yield curve. So I think it's a little bit different. It expands the opportunity set, but they're not targeting any benefit from currency exposure and like that, because it's all hedged back. But this is a very, very different situation because it's more of an active strategy, and expanding the opportunity set can improve the expected outcome. Last one. So this is a question from a listener who there's a long preamble asking whether we pick stocks or use ETFs. So I kind of cut that out. I just paraphrased it. So question, if you manage portfolios using ETFs, how would you justify that choice to other advisors in your group/firm and to clients who are used to having individual stocks? The understanding that it is almost impossible to beat the market takes a lot of time to develop, and it seems hard to do within a few client meetings. I'm getting a lot of mixed opinions with all the information I'm taking in from the financial services industry, my studies, and the podcast. So your input would be very interesting to hear. So we at PWL, like, there's no needing to justify things to each other. Like kind of we talked about this at the beginning of the podcast. Everybody at our firm is either using market cap weighted ETFs or dimensional funds. Like that's the biggest difference between any two client portfolios is they might hold DFA or they might hold market cap weighted ETFs. And many client accounts hold a mix of the two. So it's not something we spend a whole lot of time justifying to each other. We are all at this firm because we agree on the basic premise of we can't beat the market. We should keep fees and costs low and focus on things that we can control. So we're all on the same page on that. I think it would be hard to be an advisor that thinks like we do and be at a firm where the guy in the office next to you is, making fun of you for not picking stocks. And that's like I've heard from people where that's the actual situation where, like you're the butt of the joke, being the guy using index funds while everyone else is trying to beat the market. I think that'd be tough. On the client aspect, Cameron and I learned pretty early on in my time at PWL that we're not going to change people's minds in a meeting. We used to do some traditional advertising. Cameron and I used to do a radio show in Ottawa a long time ago. And we'd go on there on the weekend to do this talk show thing where we'd get asked questions about investing and people would call in and it's kind of fun. But we got people coming to talk to us through that. And we would never talk too much about indexing and things like that. It was nothing like this podcast. And so people would come in for meetings and they would expect us to be picking stocks or picking actively managed funds or whatever. And those meetings never went well. When we were just like, oh no, yeah, we don't do that. We use index funds. People would look at us like we were crazy. And then you mentioned this earlier, Dan, when we started sharing information through content and people saw exactly what we do and heard us explain exactly why we do it and came to meet with us because of that, it just made everything so much easier. There was no justifying, there was no explaining, there was no selling. It's like, I know exactly what you do and that's what I want. That's why I'm here. So that was a big shift for us. But trying to change someone's mind, like if someone comes to PWL expecting, we talked about this earlier too, even with index funds and dimensional. If someone shows up expecting one thing and you're like, no, I actually do this, it's going to be really hard to change their mind, no matter how well you can justify it.
I think that's exactly why we, have never gone that sort of route of traditional advertising after those sort of initial experiments. And we were chatting a bit about it earlier. I would say that the same is true for referrals. So very often, I'll be working with a client for a number of years. They're very happy with the service. And so they'll recommend us to a friend or a family member. And then that person will call and just sort of say, hey, I work with so-and-so, or sorry, I mean, my friend or my family member is so-and-so. They're one of your clients. They're really happy. I'm interested in coming on board too. Well, the reason that they got referred isn't because they're particularly attracted to passive investing, whether it's factor or market cap. They don't know what the difference is. They just heard that you provide good service. And so you start to have the meeting and then they'll say things. So you're like, what stocks are you buying these days? And we're like, whoa, we have to take a huge step back here and make sure that you know what we do. And I will say I've had like occasional success because some people just aren't really ideological, are willing to listen to you. And if they trust you, they will believe what you're saying. And then maybe they'll even, read up on it. But yeah, if you have to try to convert someone who feels strongly, it's dead in the water. It's never going to happen. We'll just move on, right? And just sort of say, I don't think we're a good fit for you.
I will say, I don't know I've ever come across anybody that's not an advisor that has that strongly held of an opinion, right? Like, we must have individual stocks to try to beat the market, and here's why. And unless they're like a very highly educated person or an advisor, I can explain to people in 10 minutes why that doesn't make a lot of sense. So this person's comment that it takes a few client meetings, I think this individual might be having conversations, like maybe they work for a firm and they're having conversations with fellow advisors, and there's some cognitive dissonance there, saying I was trained a certain way and it all made sense, and now I'm hearing you guys talk about this other thing, and I'm taking that information back to my colleagues or my boss, and they're kind of hand waving it away. So they might be kind of caught in the middle. And I've been in that exact situation before, and I'm sure many advisors listening to this podcast have, and Ben, I think you have as well. Dan, I think you came about it another way because you were writing about index funds before you became an advisor.
Yeah.
But it's a really difficult spot to be in. And I'll give you my opinion. This entire industry was built on product sales, right? And so we come from an industry where traditionally it's based on commission, it's based on product sales, and there's fees baked into a lot of funds. And most of these funds were actively managed mutual funds. And so if you've grown up in a shop that traditionally operated that way, and you trained that way, and you were there in the earlier years, and you're kind of older, and you're maybe got 5 or 10 years left of retirement, you're not going to upset the apple cart. You're also going to have a very difficult time just personally admitting to yourself that what you've been doing for 20 or 25 years might have been, I don't want to say wrong, but there might have been a different way. And it's much easier to just hand wave that away. And the other thing is if that turns out to be true, and you've spent all of your time with clients and they believe, and you convince them that the value that you bring to those clients is simply picking stocks, it's going to be a really empty void to admit to yourself that whole thing isn't true. But it's going to be just as hard to admit to clients that I don't bring you any actual value through my stock picking, and I haven't been doing things like retirement planning and tax planning and estate planning. And so I think there's a lot of advisors out there that keep themselves busy by talking about the portfolio all the time, doing things in the portfolio and tinkering under the guise of, look, I'm doing something for you that you couldn't do on your own. And also would just really have a tough time admitting that if I'm not doing this, I really don't know what I'm charging my clients 1% for, right? Yeah. I don't mean to paint a bunch of people with a brush, but I've been in that exact situation where I said I'm flipping to index funds, and I've had advisors at that firm I worked for go, there's no way you can show a client a statement with one thing on it. You just can't do that. They're gonna fire you. And I said, no, I don't think they are, and they didn't, right? So, a bit of a rant, but that's my strongly held opinion on the topic.
No, you're totally right. The only I have heard a little bit of it. I don't want to say from genuine prospective clients, but just in conversation, people will say things like, so if you don't pick stocks and you don't tell people when to get in and out of the market, what the hell are they paying you for? Yep. Right? Because that's what they've grown up believing too. It's not just the advisor community, it's investors themselves who've worked with advisors who think, isn't that what your job is, right? Mm-hmm. And when you say to them, no, we just try to capture market returns and we add value in other ways, they don't get that until they've seen it. And we used to joke about this all the time, is that people used to come to us for the investments, but they'd stay for the planning, because they would come in thinking, oh, what you're going to do is you're going to enhance my returns and you're going to build this amazing portfolio for me. And it's like, yeah, we are, I guess, but that is in the first 6 months, we basically set that up for you. And going forward, you're not going to stay with us just because we told you what ETFs to buy. We publish our model portfolios online. If that's all you want to know, it's not a secret. If they're going to stay, we're going to have to demonstrate values in other ways. But it's very easy to do that when you're working with a person. It's harder just in a casual conversation or when you're sitting across the table, because people don't usually appreciate the value of planning until they've actually had it. It's this old thing about you don't know what you don't know. And I think it's only after people have had a very good plan done for the first time that they go, wow, that is not something I ever got from my previous advisor. So it takes a bit of time. But again, that also presumes that you were already working with the person as the client. It doesn't work so well in talking to a prospective client.
Mm-hmm.
So. Yep. I did a video on that, I don't know when, a few years ago, because I got the same question.
Episode 247.
Yeah, I don't know. I don't even remember the title of this one. I didn't look it up beforehand. People say it to me sometimes, like in real life, I'll meet someone like, how do you remember all the stuff that you talk about in the podcast? I couldn't remember. I'm like, man, I wrote it down on a page and read it.
I have notes. Yes.